Greetings, Dr. Jeffrey Scott. This is my weekend market update for the week ending Sunday, October 9th, 2022. If you want to reach out to me, there's my email address, hgsidoc@gmail.com. If you're new to the channel, welcome. Hit the subscribe button and the alarm and you'll get notice when I post these. I typically post them on the weekend all the time, and I'll talk about what I do during the week. As always, this is for education purposes only. Anything I talk about should be considered the spirit of education, not investment advice. I'm a doctor, not a broker. I have none of the licenses that will give me the credibility nor the legal ability to tell you what to buy. You should always consult your financial advisor. The tools I demonstrate are those that I use in my daily trading, and I've paid for all the tools I use. And trading involves risk, and you alone are solely responsible for any investment decisions you make. Well, we're almost there. This starts on Monday, the Wealth 365 event. I'll have the link under the video, under the remarks or show more section of YouTube. Love to see you there. I'll be speaking at noon on Wednesday and then at 11 a.m. on Saturday. I have a bunch of indicators that are in the premium or free section of wealth charts, and the Wednesday program will be all about how I use them. On Saturday, it'll be more of the same, plus I'll go into some detail on the scanner. For me, the scanner is what makes my life easier, allows me to cut my time during the week dramatically. Speaking of during the week, I have been putting out videos on a regular basis. This is not a current screenshot, but pretty much each night or early in the morning, I'm going to record a 5 to 10 minute what I think is going on in the market, sort of a mini version of what's to follow, and it's posted before the market opens. Again, it's not investment advice, it's an education, but I'm really hoping that people use it as a vehicle, just not only to understand how I think and how I work, but to figure out how to use wealth charts and my packages, including the free one. I am committed. The December seminar will be December 4th and 5th. You might say, well, Sunday, Monday, that's a weird time to do it. Why not on the weekend or on a Thursday, Friday? And that's because my good friend John Person has a meeting on Friday and Saturday, December 2nd and 3rd, and I know we have a lot of overlap, and hopefully some of my folks will come early and attend John's meeting as well. Palm Beach Gardens, you fly into PBI, you're about 20 minutes away, you're about an hour away from Lauderdale if you can fly there direct. The hotel, I'm finalizing it, but it's going to be the same hotel as John Person, which is the Palm Beach Gardens Hilton Garden Inn at the Gardens Mall. I provide meals. You will gain weight. I guarantee it. You'll get breakfast and lunch during the meeting. On the night of the 4th, I'll take you out to one of the local steakhouses for dinner. If you attend, you'll get screen recordings as well as PDFs of the slides. And I have a bunch of I call them open source because I didn't buy them and nobody sells them. TOS and TradeStation indicators I'll share with you. I'm going to introduce some cool things that I've been doing that are not commercially available but will be at the meeting, and then the program will be platform independent. Of course, I'll be using wealth charts, but I'm also going to be using HGSI EdgeRater for looking at the markets, and then TradeStation, Thinkorswim are the main platforms I trade from. The cost is $1,000, including the meals. I limit it to 15 attendees because, hey, I don't do this to make money. I do this because I like the networking and getting together with folks, and that covers my costs, including dinner, etc. And when I say I'm going to feed you on the 4th, trust me, I'm going to feed you and give you plenty of alcohol too if you want it. So for more info, please email me at hgsidoc@gmail.com. And as I mentioned, it is going to be limited to 15 attendees, and I do not plan on doing it online. that becomes something that I think detracts from what I do for the people in the room, and those are the ones that I want to take care of. So not next year, but see you in a couple months in Florida. I actually did one of these programs at this hotel. The problem is the cost. I'll be honest, I'd have to charge probably 50% more and not feed you at a fancy restaurant. But that's about 5 minutes away on the water, great beach. I used to live next door. And if you bring your spouse, it's not a bad place to stay. I can give you more information about that. All right, so I like to review the markets looking at some of my favorite programs, little snippets from different things. And then I'll go into wealth charts because that's how I do my last step, which is try and find things that I might want to look at when we come to the upcoming week. So I'm always curious as to how the week was before. In yellow, I've got the major market indices. They are ranked here by how far they're off the 52-week high. You could see Bitcoin's down 79, ARK Innovation is down 70, the IBD 50 ETF is down 52. You know that it's a very difficult market if you're trading technology if that's the case. The FANGs are down 42%. It's leveraged ETF, so it's probably not perfectly matching up with what you see. You look at the major indexes, the Dow 20.7, NYC 20.9, Spiders are down 24, the Russell's down 31, and the two NASDAQ indices are down 34. If you go back to the bear markets in 2000, 2007, and 8, what you saw were 50% to 55% market corrections. If you think about it, we could only be halfway there. I don't expect that. I don't want to see that. The last thing I am is a perma bear. Although, man, it's been bearish for a while, hasn't it? But this could be the middle and not the end of the pullback. And I'm sort of leaning that way right now, as you're going to see. Now, over here, you can see how much they come up off the 52-week high. We had strong weeks, and you'll see here the numbers match up because we were pretty much at the 52-week lows at the close the prior Friday. IWM is still way up, has not behaved the same as the others, and the IWM has been 4 months since its 52-week low, but it's been bouncing around the same area, up 3.6. And the Qs and the NASDAQ. The NASDAQ is kind of at its 4-month low, the June 16th low, and the Qs themselves are a week off the lows. For the 113 days, the 116, those are, and let's see, and the 113, these are the things that have not violated their June lows. All these small numbers that show that 52 weeks low days since, these have all broken their June lows and have come up some. So the June lows have held a little bit. Certainly they've held on the NASDAQ and the Russell. But interestingly, they've been violated on the others, although we're up above the 52-week lows. On the sectors, energy is 58% off its 52-week lows. The 52-week lows were 291 days ago, but it's still down 12% leading the year, followed by healthcare. The worst are communication, discretionary, real estate. If you look at the last week was pretty strong. Oil really leading up 15%. And you could see 1.6 to 2.4 on the big guys, and on the small caps, 0.7 to 2.2, NASDAQ to Russell. So it was an interesting week. It felt like two very different markets to me. And I was sort of surprised when I saw how things ended up. If we look at the Q Edge tool, now I use this for a couple things. One, I have a heads-up display, which is right here at the top. It tells me on Friday all the sectors were down, all the industry groups were down, and 95% of the stocks were down. That's highly suggestive that you didn't make a lot of money to the long side. Now, seeing that, I was very surprised about how the week finished. This here gives me a sense of how many stocks are below if you're minus one, less than one, or above if you're greater than 10, the Bollinger Bands. And you'll see when I show you the buckets that we were pretty heavy and we moderated some this week. So there was improvement. If we look over the 5 days, this is the tale of two different markets. Monday, we reversed. Tuesday and Wednesday were massive up days, and Thursday we collapsed. So you could see over the last 2 days you have red pies, but over the 5-day week, we actually had a pretty good week. And even though the prior week was weak, when you look at 2 weeks, we've been positive. So the markets have come off their lows, but started strong and ended weak. Now, this is the comment I made about my surprise. The warehouse report tells me I take all the stocks in the market. There's about 12,000 tickers in hgsi, which is the source. I break them up into 10 deciles by earnings per share rank, relative strength rank, and group rank. I then look at performance by rank. This is weird, okay? So there must have been a stock that had outperformance. But overall, the performance was above 0 and less than 5% across. You compare that with the prior week where I talked about a canary in the coal mine for the bulls when we started to see some outperformance on the growth stocks. I don't see a whole lot of pattern on last week, except I was surprised. I thought the week would have looked worse when I did my review. In fact, if I do the group performance analysis, which goes from end of day Friday to end of day Friday, here was the prior week, end of day Friday to end of day Friday, almost all the groups I follow were positive. Very few were negative. So when that's the case, it just tells me that the 2 bad days at the end were not enough to wipe out all the positive during the week. Now you want me depressed. NASDAQ. NASDAQ, there's no Hindi. Of course there's no Hindi. We have to be near all highs. But what I'm looking at here are things like percent new lows, 10% versus 0.26% new highs. These numbers, big numbers, tell me weak market. Over here we had a Phoenix on Friday. Phoenix is a signal of major negative breadth, and we've got the weekly bongos are red. NASDAQ is weak. NYSE, same basic pattern without the Phoenix. We had what's called a Eureka, which is the opposite of the Phoenix that occurred on Tuesday. Got me excited, but look how we ended the week with growing percentage of new lows, and we're still red on the weekly bongo. The buckets, this is what I mean when I was talking about we have a lot of stocks trading at below 0, meaning below their Bollinger Bands. So you compare 2 weeks ago to the 7th, this was sort of the nadir or the lowest that I saw it, and you could see that very few stocks are at the bottom of their Bollinger Bands now, so that's an improvement. And we went from 96% extremely bearish, extremely oversold, stocks below the midline of their Bollinger Bands, to only 73% still bearish, but not very oversold. Now, when I saw this, you could get excited, and I think I tempered it a little bit and saying, because if we were in a bull market right now and I saw this, I would know we would have a rapid recovery. The problem is we're not in a bull market. When I go back to 2008, you can see the dates up here. You can see that this is kind of what we looked like 2 weeks ago. And look at what happened. We got worse. We got to 70% below, and then we started to recover. But we didn't recover until the 11th or 12th. So in a bear market, and we're in a bear market, these things are interesting, but they can get much more oversold. Beyond stocks, oil was strong this week, and you could see on the weekly index, it took up the oil-related. Natural gas being whipsawed on geopolitical and whether the Nord pipelines are leaking or not as strong. On the metals front, strong dollar, pretty much across the board, flat. You did see some gold and silver move early in the week, and they gave some back, as I'll show you in the charts. And if you're into dry bulk shipping, the spot index is still in a downtrend, and that's not good for pricing. This is an important chart from TC 2000. I'm looking at the 10 and 30 year. The Fed economic data are free on the web. And then this is just a reminder picture of what happened in 2008. And I'll talk about that. First thing is we're spiking interest rates and dropping on stock prices. Interest rates in white, stock prices in yellow. Second thing, look here how far below zero we are on the 2-10 yield curve. This is an inversion. Now look at all these inversions that I show you here since 1990. Do you notice the gray bars that occur after the inversion resolves? Those are recessions. So are we in a recession now? I know they argue politically because it probably will impact the sitting party in the upcoming midterms. I don't think it matters. What matters is I can go back before this, and after a yield curve inversion like this, we have a recession coming. Think about what your nest egg, your retirement funds. If you got a 5-year horizon, you're going to make a lot of money when this is over. If you're retiring now, like I am, maybe you should be raising cash. If you look here, this is the credit. This is the credit risk. I guess it's a spread, high yield index option adjusted spread. It spikes when money gets tight. And I just want to call out what happened in 2018 and 2019. You could see the market rolled over and had a bit of a crash here. Now, that was because of massive tightening in the money supply. This was 2020, but look at it back here, 2018, 2019. We know what happened in 2020. Look at where we are. We are in an uptrend. We have higher highs, higher lows. That's concerning as well. So there's a lot to be concerned. I hate to be Mr. Bear. I used to be yelled at that I was a perma bull. I'm only a perma bull when the markets are in a nice uptrend. If we look at stocks above the 200, stocks above the 40, they increased this week, kind of like the bucket. Stocks at 13-week new high, new lows came off the bottom because a week ago we were in a more obvious bounce position, and we bounced, certainly in the beginning of the week. I like to look at the upcoming news. And what does it say here? Fasten your seatbelts. Why? Tuesday we'll get some expectations on 5-year inflation. Probably no big deal. We got a PPI on Wednesday. Big deal. FOMC minutes on Wednesday. Big deal. Did you notice that 2 weeks ago for that week they had like 20 Fed governor speeches talking down the market, talking about how we're nowhere close to stopping raising the rates, and that pivot that they talk about on TV? I bet those FOMC minutes are hawkish as heck. And then on Thursday, CPI. So you might see the markets tread water until Thursday, or Wednesday rather, Wednesday afternoon, when they keep on going lower. I don't know how the market pops or sustains a pop until we get through Wednesday and Thursday. Now, I think I titled this, when good news is really bad news. Bad news is good news. If we get some really bad numbers, the market will rally because they'll think the pivot's coming. And then on Friday, we'll get some sentiment, and this has really come down, and 5-year inflation expectations. Fasten your seatbelts, folks. Earnings, not a lot, but, Delta will give us some idea of how airlines are doing. And then look at Friday, JP Morgan. And I think we're expecting their investment numbers to be horrible. That could impact Morgan Stanley. Wells Fargo, what people think is the most likely to do well on the lending, the traditional banking side. We shall see. So not a lot, but some that'll be important to hear what they do and what they say. And is everybody going to take down their earnings and sales? Expected moves. It really describes the week. Remember, this is buying a straddle at the money, meaning you're buying a call and a put, and you're really betting on a outsized move. That's it. The option makers are the smartest people in the world. They're going to price it so about 80% of the time they win. We've had a lot of outsized moves. We didn't get one this week. Here is where it opened, is the gray line. Monday and Tuesday, massive moves. Wednesday really didn't do much of a change. In fact, we had a pretty nice reversal intraday. But look what happened Thursday and Friday, back in the range. Money makers won. If you look at the same thing in the NASDAQ, same pattern. The Dow, same pattern. The Russell, same pattern. If you look at the VIX, it traded down as the markets went up and closed back in the middle where it opened. And the dollar kind of sold off in the beginning of the week and closed back where it opened. So looking at this was a pretty quiet week, and I'm not surprised that the prior numbers showed it ended up a little bit positive. I think a big question has got to be, how low do we go? So let's talk about that, because I am a little bit bearish here, and I hope that's obvious. I've been bearish for a while, and here's my thoughts. We had a great run-up. I haven't changed these numbers for today. This is where they've been sitting. I look at this area here as the next line of support. This is the initial big run-up off of the 2020 lows. Many people thought we were failing there, and then we rocketed up to the highs. I'm looking at a round number about 350 as my target. If we fail there, then I'm going to look back here and notice the 50% and the 61.8% retracements. I sure as heck hope we don't go down and visit the lows. When I talk about the pre-2020 highs in the market, it's a little bit below 350 on the S&P, and that's something I've got written on my charts, on wealth charts. If we look at the Dow, similar pattern, similar story. We've broken through the 38.2. That means the 50% retracement is our next stop, and that is at 275. See, what was that? That was the Dow. If I look at the Russell, my target's 150, which is the 61.8% retracement as we've broken through the 50%. And if we look at the NASDAQ, it's about 260, which is a 61.8 retracement. These are ugly numbers, but it just shows you how far we came if you use the reference point, the lows in the 20 rally. I've looked at it using different reference points. I think that's the right one. It's the right one for me. Some people may even look back further. On Metastock Breadth, I just wanted to show you that this is different this time, in that earlier in the year when the market was pulling back, if I look here at April and May, it was led by large caps were outperforming. Right now, small caps are outperforming. Perhaps they have less impact by the dollar. They're not having as much of their sales overseas. And where before it was value, it's kind of neutral here. Value and growth is in the middle. We are not at the lows of our breadth, although we did have a pretty wicked negative breadth day on Thursday. All right, what else do we got here? My thoughts on the market. Look at the weekly performance on the major indices. It can be a bit deceiving. The week started with a significant rally, ended with a broad sell-off, leaving small gains. GPA Warehouse Research showed some positive week performance, but from a sentiment perspective, I think we ended on a very bearish tone. The market seems to balance on each data point and Fed speech. The governors have been uniform in their hawkish tone. Responses in England, with the pensions almost going under and a cut in rates. In Australia, where they raised less than expected, gave some hope, but this was dashed by the strong employment number. So this week, especially Wednesday with the PPI and Fed minutes and Thursday with the CPI, is set up for some major volatility. Stronger than expected CPI takes us down, almost assuredly. Of course, a miss would send encouragement to the bulls. I've been doing this for a long time. I started losing in the 1989-1990 era when I went into private practice. And then I decided that education mattered just like it did for my medical degree. And I've been investing positions and swing trading now for a long time. This will pass and the markets will bottom. The economy will slow down and the Fed will become accommodative. The rates will come down and we'll have QE and markets will have a massive sustainable rally. In fact, when this is over, you'll see rallies potentially in the triple digits. From an intermediate term perspective, I still think we go lower. Short term, it's going to be news driven. It's hard for me to ignore the yield curve and the knowledge that recessions occur as we normalize, plus the tightening on the credit. Short term will whipsaw based upon news and interest rate sentiment with every economic release. This is a challenging market, reminds me of 2008. Back then I had a lot more FOMO and the market taught me a very difficult lesson. Cash remains king in my opinion. I've raised cash, I'm out of margin. I will take some long and short positions and I've done some contra ETFs, but I'm doing this with very defined risk. This is a great time to relax, read, improve your trading skill set, and wait till the market signal an easier time to participate. And frankly, it's no better time than to go to the Wealth 365 event. And again, I'll have the link for you. All right, so I've now gone through my impression of the market, and as you could tell, I'm bearish, probably bearish right now, short, intermediate, and long. My short term, I hedge a little bit in my mind because it's going to be news flow driven. Intermediate, I just don't know how we get out of this with the fact that we probably have a recession. If it's not here, it's coming. And that will ultimately be it. The recession will come in, rates will come down, and we'll get out of it. We will get out of it. Just don't know if it's anytime soon. So, aren't I a lot of fun today? I always like to start during the week and on the weekend with hot stocks. And so I just throw my ETFs in here and I look to see what's really moving. So 3 of these are bad if you're long. Volatility, strong. SQQQ, strong. SARK, short ARKK, strong. The one thing that would be something to be long, the underlying, is energy. And what does this really mean? It means that this wealth score here, all right, which is an algorithmic score, and I've got it set on the short term, has moved up. Okay, that's what it means. It means it's moved up. Now, I have to, it also looks like it's behind a week on the charting, so I'll have to ask my friends at Wealth Charts if that's me or if that's something that hasn't just doesn't have the update yet. But this tells me what's working, and I think the number is what's meaningful here. Now, if I go and I look at indices, we all know what's going on. Let's just take a 5 minutes of the spiders. What happened on Friday? We had really, what perceived as stronger than expected employment. We gapped down, we traded lower the whole day, and what is this yellow line? The June lows. And what did we do? We bounced around the June lows most of the afternoon. If we look at the 50 on the daily chart, you could see we are looking at the June lows here. We closed right in that area, and we'll see where we go on Monday. Look, the white line is the highs before the 2020 bear, and that's very similar to where I think the target is. I think the target for the fibs is in between these two, but I do think that the June high becomes potentially, the June low in white, June low in yellow. If it breaks down, then this is the January high in white of 2020 becomes the next target. God forbid we end up going down to the lows, the March 2020 lows. All right, that's about half of where we were trading in August. I don't expect that. Q's bouncing off the June lows. The Dow, it broke below the June lows, but it's been around it for the last several days. The IWM is holding above the June lows. If we look at volatility, we can see that it's been moving up. Let's see if I get it to be bigger. I guess it's not going to go any bigger on me. It's been moving up. It's got some overhead concerns there with that 200. And another driver in the market's been the dollar, and we can see the dollar was up after the pullback on Tuesday, which is, of course, the big bullish day in the stock market. On the commodity front, if the dollar started going better, then you know gold and silver are going to stall. Oil, because of geopolitical, OPEC saying, OPEC Plus, they're going to cut 2 million barrels. But the more I listen to it, I'm not even sure what that even means, because they're not hitting their quota right today. But you could see 10-year continues to be bouncing around near its high. Yes, on Thursday, you had on Tuesday, you traded much lower, and that, again, was probably supporting the rally. I have a simple timing model that I teach people, and the reason why it's white and yellow is I have two different types of moving averages. I have a 30-week WMA and a 30-week SMA, and I like to put both of them there. But what I'm looking at is a weekly chart, price relationship to those moving averages. It's below on all of them, and then my bongo. When I have a price is above and a green bongo, I buy. When price is below and a red bongo, to me, it's a no-buy zone. Now, obviously, nothing's as black and white as that, and occasionally you'll find some counter-trend acting stock. You may have some FOMO, but this is not a market you want to be all into the long side, for sure. Market theme, again, as I showed you on the Metastock market breadth shot that I have, is you could see that IWM is lagging, is leading rather here versus IWB. They're both down, but when it's down in this corner, it's favoring small caps, and down here, it's favoring value versus growth up here. The reason why I'm looking at the short-term charts here is because this is a flip-flop, as I showed you before earlier in this pullback going up until May. Large caps and value were in charge, and now it's small cap and value. I like to look at what's working on a short-term charts, and these are ratio charts of the sectors versus the spider. So I'm sort of normalizing performance versus the SPY, and then I'm comparing them. And what do I notice? I notice that energy is the most in the upper right-hand corner. This is the leading group right now. I know that financials have teased, and I didn't put a star there because of all that earnings coming. Industrials been holding up. Materials looks like they want to come up. And then when I come down here is healthcare. And I will use that intraday daily to see what's working right now. The shorter term measurement is the blue. If you're blue at the end, you're strong in the last couple of hours. Up here is a couple of days. So it's a combination of blue in the upper right hand corner that gets me excited. You could take it down to further intraday. To me, the hourly one has worked the best. Now, I could also look at the markets using the various scanners that I like. So let's start with the heat map. And the heat map on the S&P 500 is pretty ugly. How about the NASDAQ 100? I don't know if that's that's probably it because there's no energy stocks there. How about the Dow 30? As you can see, there's a lot of red on Friday. I love looking at this during the day. It tells me what's working, what's not working. And industrials, energy, here's your financial services. If we look at the weekly, again, I think the technology skewed a little bit. Energy, industrials, Cyclicals made it. So I've already built my watch list by taking, for example, energy's hot right now. So I could take energy and do compare. And then I could look at rank it by daily algo score. And you know what? I like all of energy, so I'm going to hit all the subsectors. Then I'm going to hit compare. I'm going to rank it by daily algo scores. And then I'm going to go down here. I'm going to hit that box. And now I want to put all these energy stocks into a watch list. And I want to put it in what I call my weekend review watch list. Make sure it's set there. It is. And I'm just going to go add it to the watch list. You'll see it up here. And now I know that the energy stocks are the top ones that are in my top-down review. I'm a top-down guy, which means what's the market doing? Well, obviously I'm not bullish. What the leading sectors, and within those sectors, what's the leading industry group, and then what's the leading stock. So I usually go a third of the market, the top third in sectors, and then the top 20 or so industry groups, and then the top couple hundred stocks into my list. Wealth Scanner is another way of doing this. I love this tool. And now I'm not restricting it to the hot stuff, and I'm asking what are the leading things. Now I'm looking to the upside. Short treasuries, this is nothing new, and you can see how it's been doing very well. Why is that not going? All right, here we go. And you can see short treasuries. Don't you wish your portfolio looked like that right now? UVXY, we know that's a volatility ETF. There's your energy, there's your dollar, silver, oil, commodities. Commodities are interesting here. And they may be making a comeback. And commodities don't necessarily do bad in inflation. Oil services, oil production, gas, gold. So there's not any technology to the long side here. There's really no discretionary to the long side. It's things that go up when the markets go down, and it's commodities, and the big commodity is oil. So CAT scanner, I typically do a bullish and a bearish review. So I've got a weekend review list, which to me is my top-down list that I've built. It's got my combo list, which are leaders of the major indexes, and then it's got a top-down list built by stocks in those leading industry groups and the leading sectors. Now, on my scanner, squeeze is the typical Bollinger Band squeeze inside the Keltner channel. It's nice to have. It's not mandatory. What does a squeeze do? Squeeze has some built-up energy, and if you move one way or the other, you get a big move. That's why the squeeze is good. All right. The dots, I have 4 dots. I have a gap, momentum, breakout, and volume. These are all things that I have found when I look at lots of charts that are associated with a good move in the markets. So why look at 1,000 charts when I can look at 30 of them that have one of these 4 dots? And if the dots are good, if I'm in the direction I want to be, then maybe 4 dots is better than 3 and 3 is better than 2. Just a thought. Bongo daily and weekly, these are my trending indicators. The daily is short term, my weekly is a long term, and I could look down and I could see a couple of things. When I see AEHR up at the top, I know that since it's been in a bullish formation on the Bongo weekly for 11 weeks, that the stock has moved off of its lows. But the fact that the daily is brand new, or if it was a 1, 2, or 3, or 4, would tell me that it just reversed back to the upside after having a counter trend short-term move. So what do I like to buy? I like to look at stocks with lots of dots that are in a longer term uptrend that have a very recent reversal. And that's what has come to the top here. AMBAC Financials, I think they had their earnings come out. I don't know their story. And I think financials have been, I showed you they've had some recent strength. But here's a regional bank, I believe. I don't know for sure. Massive volume day, a gap, on volume, a breakout in momentum, a new daily bongo. That's why it says new. The weekly bongo was green already because it's already reversed on the longer time frame. Relative strength and OBV. All right, I like that. ATCO should look similar with longer term bullish trend. And here you can see it's had a longer time off the bottom, but it had a recent pullback and a breakout. It's a red candle, which means it closed lower than it opened, but it was a major up day on volume. The one I liked, one of them was AEHR. AEHR is an information technology company. You can see on the weekly a breakout, a pullback, and then a breakout off the 50-day, and you can see on massive weekly volume. In fact, looking here, relative strength turned back up back in July. And then what happened on the daily is we had a pullback and a breakout. Took out all the moving averages on massive volume. You've got I guess it didn't qualify for the gap. You had a breakout on volume, momentum, and the bongo just switched. I know there's been some talk about DraftKings. DraftKings is about to take out its 200. It had some major volume on Friday. It's got to get above the 200, and like many of the stocks that I may show you, it'll have a lot of overhead supply because look how much DraftKings has recently come down. Cano, C-A-N-O, was another one I liked. And what a beautiful pattern of this healthcare, I believe, services company. You could see on the weekly it reversed higher here. It's had a lot of volume. You had a big move up here. Little consolidation. Looks like it's getting ready to run. I'd want to make sure this isn't a takeout candidate. Now, I could go through the list. I typically do. Here's one that's in a squeeze. ESPR. Boy, this used to be a lot more. This is a biotech or specialty pharma stock, depending upon who's grouping them. And you could see a pullback to the 50, and then a breakout momentum, decent volume. The daily turned green, the weekly's been green for a while, and a turn up in relative strength and OBV. I like that pattern as well. The benefit of the squeeze is I'm not finding it up here, I'm finding it down in the consolidation. So I typically go through that. On the bearish side, same story. On the bearish side, I'm going to look for bearish dots. And when I look at the Bongo Weekly, this is how many weeks it's been going down. And all of these are stocks that were short-term going up that turned back down. So those would be a retracement in a downtrend. And that's where I like to go fishing to the short side. When that comes up to the top, Applied Materials. And, you know, these things have fallen a lot, and I'm not sure I would be chasing down. But from an education perspective, clearly it's in a downtrend on the weekly. And it had a short-term pullback or retracement on the daily and a breakdown. All right, CDNS, I think, also is a similar pattern where longer-term uptrend and then it started pulling back. And here was a retracement and a failure at the 50, failed now at the 17. This one looks interesting. CNC is a insurer, and you could see long uptrend now breaking down. The weekly bongo's been in play for a number of weeks, and we broke down. So you had a retracement and now a breakdown to the short side. Some others that maybe should make me nervous because they've been big leaders. Lantheus Holdings, this is one that has been a huge leader. Had a gap down on massive volume on Friday. We're starting to see some of the big winners, and I would put an asterisk because I guess probably not a lot of big winners, but some of the recent market leaders. Look at that stock's uptrend, an IPO, or I don't know if it's an IPO or not. I think it was a recent IPO, but it has broken down here. Now, it does have support probably here at the 200. Look at the volume on this breakdown. Look at the relative strength and OBV have turned down as well. Another big recent gainer that has turned down is Shockwave. Now, this may turn out to be a great buying opportunity, but it's had a big run up, and you saw it correct over here. But the scan, let's see, this had 2 dots, so if I go down low enough, we'll find Shockwave, because it would have made the scan somewhere down here. All right, so I look at the markets that way. Now, I've made it very clear I'm not bullish here. So if I believe this market is going to continue to go lower, I might want to pull out something like the contra ETFs list and take a look at them. And remember, these ETFs, which you can often hold in an IRA where you can't hold options or go short, these long ETFs will go up when the markets go down. So if you look at the DOG, for example, if the Dow is going down, the DOG is going up. If you look at SARK, which was made our hot and our leaders list, this will go up when the ARKK stocks of Cathie Woods go down. SDS or SPXS will go up when the S&P 500 goes down. SOXS will go up when semiconductors go down. So this goes up when they go down, and then there's an opposite, SOXL, that goes up when semiconductors go up, and this one obviously is looking pretty weak right now, especially after the warning that we saw come from AMD. Short the Qs, SQQQ goes up when the Qs go down. TZA goes up when small caps go down. So you have a number of instruments. Now the problem with the market right here is this. We're sitting at what I think could be an important area of support. Now I've already told you that in my opinion, which is just an opinion, that this market is likely to go down further. But I also told you that short term we're going to be whipsawed by the news. So I'm struggling to want to go too short right here because it seems like the obvious trade, but what if the CPI misses to the downside? I could be left holding my shorts with the market having another rip to the upside. At the same token, with that news sitting in front of us, I think it's tough to overdo it to the long side, certainly until we get through this week and get a signal that it's time to go into this market. So it's like I said, it's a really hard market here. Cash is king, and there are things that you can do that are lower risk positions. Some of them are option strategies, and they're things that I'll talk about at my live meeting for sure. And I've got a couple positions on, some long, some short, but they're very low risk, defined risk strategies. And to me, that's what you got to do down here. You could go all into the long side and be right and look like you're brilliant. You could be all into the downside and be right and look like you're brilliant. To me, it's about capital preservation, and I'll have plenty of time to be looking like I'm brilliant and making money in the market when it gets easier. Now, a lot of people like me to show you the things that I'm looking at on the long and short side, so let me just call out some of the things I liked. Now, there's a big list here, and maybe what I like the most is Brent oil, and you could see how it's broken out here from a downtrend, and there's probably a trend line that could be written as well. So we broke above trendline resistance. We know the price of oil is likely to go higher. That was one I liked for that reason. Um, Not all of these are in great buy points. AEHR I thought was in a good buy point. I showed you Cano. COM is one that we looked at on one of my daily last week. This one held up well despite the market rolling over into the end of the week. Dexcom is interesting for a couple of reasons, and let's see if I don't screw this up. One of the reasons why Dexcom is interesting is because of seasonality. And yeah, it doesn't, oh, that's not long enough, is it? So we are sitting October 9th. Five more minutes. And just look right here on the projected seasonality opportunity. 10% return over the next 6 weeks, 8 times up, 2 times down. I do like seasonality, but what I liked about it was big gap up on tons of volume, and it's a strong part of the season for Dexcom. There's a lot of energy plays here. There's a lot of biotech. There's also a couple of casino stocks, and we talked about this during the week. This is Melco, and these things are really clobbered, and I could put up Melco, I could put up Wynn, I could put up Las Vegas Sand. And if China opens up, these things could have a lot to run. I've been in them for a little bit. Sting had a little bit of a pullback and looks to me like it's getting into an interesting position. I'll look to have some dots come in before I'd go long, but that looks compelling. So these are some of the things I'm looking at. And I think I'm going to run out of battery in a second, so let me say a comment or two about the short side, and then I'm going to say goodbye. There were a lot of shorts out there, and I showed you some. Cadence, CNC were 2. How about Empower, MPWR? And again, what am I looking for? I'm looking for expensive stocks that had major run-ups that have been trading down, and then they had a retracement, and they're breaking down again. MPWR is perhaps the big picture there. Public storage is another. Now again, these have all broken down and lost a lot of money. I think they go down lower, but I think the risk is higher now. So be careful this week. No FOMO allowed. Cash is king. It'll be easier sometime in the future. Thanks for joining me. Hope to see you at the Wealth 365 event.